$38 trillion. That's America's national debt right now, today. No warm-up, no introduction, no channel branding, just straight into the shock. So in our script, chapter 1 is the hook. It is the opening of the entire video. The moment the voiceover begins, that is chapter 1 already running. Here is how the flow works. Chapter 1 is the hook, and it bleeds directly into chapter 2 without any pause or break. The viewer should not feel chapters at all. They should feel one continuous, urgent, flowing conversation that pulls them forward from the first word to the last. The chapter structure is only for us, so we can build the script piece by piece with precision. So shall I start writing chapter 1 now? Just say the word and I will write it in your competitor's exact voice, tone, and style. While you were sleeping last night, something moved. Not slightly, not marginally, but in a way that every major institutional trader on Wall Street woke up this morning and immediately started recalculating their positions. China moved. And when China moves, what happens next on Wall Street is not random, not unpredictable, and definitely not a coincidence. It follows a pattern. A precise, documented, mathematically consistent pattern that has played out the same way 3 times in the last 30 years. Same signals, same sequence, same outcome for anyone who wasn't watching. Now here's what nobody on financial television is going to tell you this morning. The mainstream media will cover the numbers. They'll show you the charts, they'll bring in the analysts, they'll debate the percentages, but what they will not tell you is what those numbers actually mean, why they happened, and what is coming to Wall Street within the next 48 to 72 hours as a direct result. Because by the time CNBC is reporting it, the smart money has already moved, the institutions have already repositioned, and the average investor is once again the last person to find out. That ends today. Because what I'm about to show you is the exact framework that institutional traders use to read Asian market signals before Wall Street reacts. It's not complicated. It's not secret. It's documented capital flow, public data, verifiable numbers that anyone can access. The only difference is knowing what to look for and what it means when you find it. Stay with me, because the next 20 minutes will permanently change how you read markets every single morning. Here's what actually happened while American markets were closed last night. The Shanghai Composite dropped 1.4%, not a massive number on the surface, not the kind of figure that makes breaking news headlines. But here's what that number is hiding and why it matters more than anything else you will read in the financial press this morning. Underneath that 1.4% drop, Chinese institutional investors pulled approximately $4.2 billion out of technology and export-heavy equities in a single session. Not retail investors panic selling, not algorithmic noise. Institutional money, calculated, deliberate, and systematic, rotating out of the exact sectors that have the deepest correlation with American markets. The Hang Seng followed, down 1.8%. Then the Nikkei in Japan, down 0.9%, confirming the directional signal was not isolated to mainland China. It was regional. And when Asian market selling becomes regional rather than isolated, the 48 to 72-hour Wall Street impact window opens immediately. Now, here's the part the headlines completely missed. The People's Bank of China set the yuan midpoint fixing this morning at its weakest level in 11 months. That is not an accident. That is not routine monetary policy. That is a deliberate signal from Beijing about where Chinese economic priorities are heading, and it has direct, measurable consequences for American equities, American bond markets, and the dollar itself. The mainstream financial media saw the surface numbers and reported the surface story. But the surface story is never the real story. What happened in Asia last night was not a market fluctuation. It was a message, and Wall Street is about to receive it whether it is ready or not. The average investor never saw it coming. Stage 1 of the pattern, verified. Write the chapter 5. 270 word without heading more or less. Everyone knows the name Lehman Brothers. Everyone knows the mortgage crisis, the bank failures, the bailouts. The story has been told 1,000 times, but here's the version nobody tells. The version where the signal came from China first, weeks before Wall Street admitted anything was wrong. August 2008. 6 weeks before Lehman Brothers collapsed and took the global financial system with it, Chinese manufacturing PMI dropped to 48.4. Anything below 50 signals contraction. But it was not just the number itself. It was the speed of the drop. 3 consecutive months of accelerating contraction in the world's largest manufacturing economy. Chinese export orders were collapsing. Factory output was falling. And the institutional traders, who had Asia desks, who were watching these numbers in real time, started moving. Goldman Sachs reduced equity exposure in early September 2008. JP Morgan restructured institutional portfolios. Bridgewater Associates had been warning internally about a liquidity crisis for months. They were not psychic. They were reading the China signal and understanding exactly what it meant for American corporate earnings, American credit markets, and American banks that were already overexposed to toxic assets. The average investor was watching CNBC in August 2008 and hearing that the fundamentals were strong, that the economy was resilient, that the housing correction was contained. Meanwhile, Chinese capital was already leaving, quietly, systematically, the same way it always leaves before the storm arrives. September 15th, 2008, Lehman Brothers filed for bankruptcy, the largest bankruptcy in American history. Markets collapsed. Retirement accounts were destroyed. The middle class lost trillions. The signal was there 6 weeks earlier. In Chinese manufacturing data, publicly available, completely ignored. Same pattern, different decade, verified. August 11th, 2015. Most American investors remember that summer as relatively calm. Markets were high. The Federal Reserve was talking about rate normalization. Everything felt stable, controlled, manageable. Then China made one decision, one single policy decision that sent shockwaves through every major market on Earth within 72 hours. The People's Bank of China devalued the yuan by 1.9% overnight. On the surface, 1.9% sounds small. It sounds like a rounding error, like a technical adjustment, like something that belongs in the footnotes of a financial report rather than the headlines. But institutional traders understood immediately what that number actually meant. It meant Beijing was worried. It meant Chinese economic growth was slowing faster than official data was admitting. It meant the world's second largest economy was in more trouble than anyone had publicly acknowledged. The smart money moved within hours, not days, hours. Major institutional portfolios began rotating out of emerging market exposure, out of commodity positions, out of anything with significant Chinese revenue dependency, quietly, systematically, without a single press release. August 24th, 2015. 13 days after the yuan devaluation, Wall Street opened and immediately dropped 1,000 points in the first 4 minutes of trading, the single largest intraday point drop in American stock market history at that time. $2.1 trillion of global market value disappeared in a single session. Investors called it Black Monday. They acted like it came from nowhere. It did not come from nowhere. It came from Beijing, 13 days earlier, in a publicly announced policy decision that told anyone who understood the pattern exactly what was coming next. The signal was there. Most people missed it completely. Third proof, pattern locked, verified. Because what China is doing right now, this week, follows the same pattern with a precision that should make every serious investor stop and pay very close attention to what comes next. The People's Bank of China has set the yuan fixing rate at its weakest level in 11 months 3 consecutive times this week. Not once. 3 consecutive times. That is not routine monetary policy adjustment. That is a deliberate, calculated signal from Beijing that China is prepared to let the yuan weaken further, which means Chinese exports become cheaper, which means American manufacturers competing in global markets face immediate margin pressure, which means corporate earnings forecasts for a significant portion of the S&P 500 need to be revised downward starting now. Simultaneously, China's Treasury holdings data released this month shows Beijing reduced its American Treasury position by another $18.4 billion. That brings the total reduction since 2013 from over $1 trillion to approximately $760 billion. They have sold more than $300 billion in American Treasuries over the last decade, not randomly, systematically, consistently, every single quarter moving in the same direction. And this month, Chinese institutional capital flow data shows significant rotation out of dollar-denominated assets into gold, into European infrastructure, into Southeast Asian manufacturing corridors. The same capital rotation pattern that appeared 60 days before the 1997 crisis. The same pattern that preceded the 2008 signal. The same pattern that warned anyone watching 13 days before Black Monday 2015. 3 data points. 3 consecutive yuan fixings. Continued Treasury selling. Institutional capital rotation. All happening simultaneously. All pointing in the same direction. This is not coincidence. This is stage 3 of the pattern. And it is unfolding right now in real time. Every major financial institution in America, Goldman Sachs, JP Morgan, BlackRock, Morgan Stanley, Bridgewater, every single one of them has a dedicated Asia desk, not a small team, not a junior analyst checking overnight numbers before the morning meeting, a full, sophisticated, real-time monitoring operation specifically designed to read Chinese market signals before they arrive on American shores. Goldman Sachs has been running quantitative models on Chinese capital flow data since the late 1990s. JP Morgan's Asia-Pacific division employs hundreds of analysts whose entire job is to translate Beijing's policy decisions into Wall Street positioning adjustments before the market opens. BlackRock, managing over $10 trillion in assets, has proprietary algorithms that track yuan fixing rates, Chinese institutional fund flows, and PBOC policy signals in real time, 24 hours a day, 7 days a week. And when those models flash a warning, they do not issue a press release. They do not call CNBC. They do not write a research note for retail investors. They move quietly, systematically, the same way they always move. repositioning billions of dollars of institutional capital before a single mainstream headline is written. By the time you read about it on financial news websites, by the time the analyst appears on television to explain what happened, by the time the narrative is packaged neatly for public consumption, the repositioning is already complete. The institutions are already protected. The smart money has already landed safely on the other side. And the average investor is left holding positions that made perfect sense yesterday but are bleeding this morning with no idea why. This is not accident. This is not coincidence. This is the system working exactly as it was designed to work. For them, not for you. Here is what most investors never understand about global markets. Nothing that happens on Wall Street happens in isolation. Not a single major move, not a single significant crash, not a single bull run that lasted more than 18 months has ever occurred without a preceding signal coming out of Asian markets first. Not once. Not in 30 years of documented capital flow data. And I know that sounds like a bold claim. So let me show you exactly why it is not a claim at all. It is a pattern. A mathematical, repeatable, historically verified pattern that institutional traders have been using quietly for decades, while the rest of the investing world stares at domestic indicators and wonders why they always seem to be one step behind. Here is how the pattern works. When Chinese institutional capital begins rotating out of growth assets systematically, not randomly, not reactively, but systematically, Wall Street feels it within 48 to 72 hours, every single time. The mechanism is not complicated. China's manufacturing output drives corporate earnings, forecasts for American multinationals. Chinese consumer demand directly affects revenue projections for the biggest names in the S&P 500. Chinese capital flows move through Hong Kong, through Singapore, through London, and they arrive on Wall Street carrying either confidence or fear, depending on what Beijing decided 3 days earlier. This is not theory. This is not speculation. This is documented, verifiable, publicly available capital flow data that tells the same story every single time it unfolds. 3 times in the last 30 years, this exact pattern triggered a Wall Street disruption that the average investor never saw coming. Let me show you all 3, because the third one is happening right now. Most people remember it as a distant financial crisis that happened somewhere in Asia. Something about currencies, something about the IMF, something that felt very far away from American portfolios and American kitchen tables. It was not far away at all. Here's what actually happened. May 1997, institutional currency traders began quietly exiting the Thai baht. Not loudly, not with press conferences, not with analyst reports, quietly, systematically. The same way smart money always moves before a storm. Within 60 days, the baht collapsed 40% against the dollar. Thailand's entire financial system went into freefall overnight. But here is what nobody talks about. The warning signal was visible 2 months before the collapse. Foreign reserve data, published publicly by the Thai Central Bank, showed reserves dropping from $38 billion to $2.8 billion in a matter of weeks. The smart money read that number and was already gone before the headlines arrived. The crisis spread instantly. Malaysia, Indonesia, South Korea, one after another, same pattern, same sequence, same devastation. Then it hit Hong Kong. And the moment Hong Kong markets started showing institutional selling pressure in August 1997, Wall Street had exactly 72 hours before the impact arrived. The Dow Jones dropped 554 points on October 27, 1997. At the time, the single largest point drop in American stock market history. Billions of dollars of American wealth evaporated in a single session. The signal was always there, 60 days earlier, in publicly available data. Institutional traders read it, repositioned, and protected themselves completely. You are thinking that China and America are decoupled, that the trade tensions, the tariffs, the political rhetoric, the supply chain shifts of the last several years have fundamentally separated the two economies, that what happens in Shanghai no longer has the power to move markets in New York the way it once did. It sounds reasonable. It sounds logical. It is completely wrong. Here's the data. American companies in the S&P 500 generate approximately $700 billion in annual revenue directly tied to Chinese consumers, Chinese manufacturing, and Chinese supply chains. Apple alone generates 19% of its total revenue from Greater China. That is not decoupling. That is dependency wearing a different name. And I know some of you are also thinking that the American economy is fundamentally strong right now, that employment numbers are solid, that consumer spending is holding, that the Federal Reserve has the tools to manage whatever comes next. And on the surface, those things appear true. But Spain's economy looked strong in 1555, while the smart money was already leaving. Britain's trade numbers looked solid in 1965, while institutional capital was quietly relocating to New York. Surface strength and structural vulnerability are not the same thing. They have never been the same thing. And for those of you thinking this time is genuinely different, that America's technological dominance, military power, and institutional depth make it immune to patterns that destroyed every previous reserve currency, I want you to remember something very simple. Every empire that ever collapsed believed exactly that about itself, right up until the moment it didn't. The pattern does not negotiate. It does not make exceptions. It just unfolds. So what does all of this mean for you practically, specifically, starting today? Because understanding the pattern is only half the equation. The other half is knowing what to do with that understanding before the 48 to 72-hour Wall Street impact window closes. And that window, based on everything the data is showing right now, is already open. First, watch the sectors with the heaviest China revenue dependency today. Technology, semiconductors, consumer discretionary, industrials. These are the first sectors to feel Chinese capital rotation in their earnings projections. When institutional money starts moving out of these sectors before the broader market reacts, that is your earliest confirmation signal that the pattern is accelerating exactly the way history says it should. Second, pay attention to the dollar index this morning. When Chinese institutional capital rotates out of dollar-denominated assets at the scale the current data suggests, dollar strength becomes inconsistent, unpredictable, and dangerous for anyone holding concentrated dollar exposure without a hedge. This is not the time for concentrated positions in anything. Third, watch gold. Not because it is a panic trade, because historically, every single time this exact pattern has triggered a Wall Street disruption, gold has moved in the opposite direction of equities within the same 72-hour window. The 1997 crisis, the 2008 collapse, the 2015 Black Monday. Gold was the institutional hedge every single time. Fourth, reduce leverage today, not tomorrow. Today. Rising volatility and leveraged positions in a market that is about to receive a China signal is the most dangerous combination in investing. The people who got destroyed in 2008 were not just wrong about direction, they were leveraged while being wrong. Fifth, stay informed beyond the headlines. The data is public. The signals are visible. The pattern is documented. The only thing standing between you and the same information institutional traders use every single morning is knowing where to look and what it means when you find it. That knowledge is the only edge that cannot be taken away from you.